Imagine you spent 30 years building something. Not a company, not a startup, just a life. A house paid down to 60%, a retirement account with a comma in it, a small rental property that covers its own mortgage, maybe a business that finally stopped bleeding money and started making it. 30 years, quiet decisions, delayed gratification, compound interest doing its slow, patient work. And then one document, one clause you didn't read carefully enough, one liability you thought was manageable. Gone. Not slowly, not dramatically, just structurally gone, like a load-bearing wall that quietly cracked, and then one morning the ceiling came down. This happens more than you think, and the most dangerous part is that most people don't see it coming because the liability didn't look dangerous when they took it on. It looked like an opportunity. Let's talk about what a liability actually is, because the textbook definition isn't the one that ruins people. In the simple version, a liability is anything you owe: a mortgage, a car loan, a credit card balance. Most people carry some version of all three, and they're fine. They're manageable, they're priced in. But there's a category of liability that doesn't behave like those. It doesn't sit still. It doesn't send you a monthly bill you can plan around. It grows. It compounds, it changes shape, and by the time it becomes visible in your financial life, it has already done most of its damage. These are what we might call asymmetric liabilities. The downside is theoretically unlimited. The upside, whatever you thought you were getting into it for, was always capped. A personal guarantee on a business loan is one. A co-signed mortgage for a family member is another. Certain legal settlements, margin loans on investment accounts, tax debt that wasn't addressed early, a lawsuit in an industry where you have personal exposure. The thing all of these have in common is that when you took them on, they felt like a small, controlled risk attached to a larger opportunity. And that framing, that's the trap. Here's a real pattern that plays out in family wealth destruction. I'm not naming anyone because you've seen some version of this story yourself. Person builds a business over 20 years. Revenue is strong. They expand. To fund the expansion, they personally guarantee a commercial real estate lease and a business line of credit. They sign both documents on a Tuesday afternoon, maybe a little rushed because the deal felt solid and the lawyer said it was standard. The business grows for 3 more years. Then the market shifts. The expansion location underperforms. The business starts contracting. They close the new location. They think they're done with it. They are not done with it. The landlord sues on the personal guarantee. The lease had 7 years left, 7 years of rent at $12,000 a month. That's just over $1 million in exposure. The bank calls the line of credit. That's another $400,000. Now here's where it gets structurally interesting. And by interesting, I mean devastating. The person's other assets, the home, the original business location, the retirement account they built before any of this, those weren't involved in the expansion at all. They had nothing to do with the failed lease, but because of the personal guarantee, a judgment creditor can come for them anyway. The home, depending on state exemption laws, may or may not be protected. The retirement account has some federal protection. The business equity in the original location, highly vulnerable. One liability, one signature, years of unrelated work now in the blast radius. This is the mechanism most people don't understand. Assets and liabilities don't live in separate compartments in your financial life unless you've deliberately, legally constructed those compartments in advance. If your assets are held in your personal name, which most people's are, they are exposed to your personal liabilities, all of them, including the ones you signed for someone else's benefit, including the ones from a business you no longer operate, including the ones that haven't become judgments yet, but will. Wealth, real, durable wealth, is partially a construction project. It's not just accumulation, it's architecture. And most people accumulate for decades before they think about structure for even an afternoon. The financial industry, broadly speaking, doesn't push back on this. Advisors help you grow your portfolio. They don't typically audit your liability exposure. Insurance agents sell you policies. They don't draw org charts of your legal risk. Attorneys draft documents. They don't always explain what you're signing your whole financial life into. So you end up with a large pile of assets and a liability structure that was never really examined as a system. Now let's talk about the math, because the math is where the irony becomes almost absurd. The average American household takes roughly 25 to 30 years to accumulate meaningful net worth. We're talking home equity, retirement accounts, maybe a small investment portfolio. The median net worth for households aged 55 to 64 in the United States sits around $250,000. For homeowners, higher. For the top quartile of earners in that range, you might be looking at somewhere between $500,000 and $1.5 million. That's decades of work, decades of choosing the 401k over the vacation, decades of not touching the account when the market dropped 40% in 2008 or 30% in 2020. And a single personal guarantee on a failed business expansion can legally pursue that entire pile. A creditor with a judgment doesn't care that the assets came from somewhere else. They care that the assets are reachable. And if they're in your name, they are reachable. Here's the quiet irony. The people most likely to face this situation are not reckless people. They're ambitious ones. They're the people who built something worth taking. They took on a liability because they were expanding, growing, optimizing. They were doing exactly what financial culture tells you to do. They were not playing it safe. And that instinct, the one that built the wealth, is the same one that exposed it. There's a version of this that plays out in family dynamics, and it's worth slowing down for. Someone co-signs a loan for a sibling or a child or a parent. It feels like love. It is love. But from a legal standpoint, it's something else entirely. You are now a primary borrower on a debt you have no control over. You cannot force the other person to pay. You cannot monitor the account without them. You can't refinance it. If they stop paying, the lender doesn't negotiate with them. They come for you. Student loan cosigners have lost homes over this. Business loan guarantors have had their personal investment accounts seized. Tax debts from jointly filed returns have followed spouses into divorce and pursued them years later. The liability doesn't care about the relationship. It doesn't care about your intentions. It cares about the contract. There's a timing problem that makes all of this significantly worse. Liabilities tend to become dangerous exactly when your assets are most vulnerable. When a business fails, cash flow dries up. When a market crashes, your liquid investments are down. When a legal judgment drops, you may not have the liquidity to settle even if you wanted to. So the liability doesn't just come for what you have, it comes for what you have at the worst moment to give it. Meanwhile, the assets you spent years compounding are suddenly being unwound at an emergency timeline, at distressed prices, under legal pressure. That $400,000 brokerage account gets liquidated quickly. You don't get to wait for the market to recover. You sell at whatever price exists that week. This is how 30 years of compounding gets neutralized in 18 months. The uncomfortable conclusion, and it's not a clean one, is that the financial conversation most people need to have isn't about returns. It isn't about which index fund. It isn't about whether to invest in real estate or stocks or small businesses. It's about liability architecture. It's about understanding what you're signing, what your exposure is, and whether your assets are actually protected or just sitting there in your name, exposed, waiting. And that conversation is genuinely boring. It doesn't have the dopamine of watching a portfolio grow. There's no dashboard for it. Your advisor probably isn't bringing it up because it's outside their scope and it doesn't generate a fee. So most people don't have it until they have to. Here's the question I'd leave you with. Right now, today, if someone got a judgment against you for an amount equal to your net worth, how much of what you've built would they actually be able to reach? Not in a panicked way, just as a real question. Because the answer for most people, if they've never thought about it before, is probably more than they'd like. And that gap between what you think is protected and what actually is, that's where lifetimes of work go to disappear.